So recently I've had a lot of questions about Hims and Hers, and I thought, you know what, let's give it some attention, let's see what's going on, let's see what the risks are to Hims and Hers, and could it actually become a 5x return stock. And for me, I bought Hims and Hers because I do think it has plenty of upside. I do think it is a high risk company, but I do believe the upside is there. So let's look at what potentially could happen, or what has to happen for it to come one of those big returning stocks. So hope you enjoyed the video. Let's get started. So without doubt, the stock is getting a lot of attention because it is a volatile one, and it is at the moment creating a bit of an opportunity or a dip. As you can see here, the stock did peak around $12 at the 5th of May, and since the 5th of May the stock has been going lower and lower, and it is actually down nearly 42%. But it is normal for Hims and Hers to do that. It can be a little bit frustrating as a shareholder, but you can see here it came through as a SPAC. It did go all the way up to $23, which without doubt in my opinion was overvalued, but it does show you that it can go on them sort of runs. And then it went all the way down from $21 down to $3, and it seemed to get brought into the kind of general because it came through a SPAC at the time, that it was kind of one of those trash SPAC stocks. Then all of a sudden everyone kind of realized that it's not one of those, and then the stock rallied up to $12 as we just pointed out there. But now it's having an opportunity where it's back down in $6 in my opinion right now. And obviously what I would say with Hims and Hers and the stock market in general is that sometimes when the sentiment is there, it can go on to good runs. When there is negative sentiment in the market, it is a stock that does dip down, but sometimes that could potentially give you a buying opportunity into the company. Now obviously Hims and Hers I'm a big fan of. I think most of you guys know I'm a Hims and Hers fan. I recently did a review of their Q2 earnings, as you can see here. It was about 12 days ago, and I broke the earnings down for about 22 minutes, quite a long video, and obviously saying why I thought the earnings were fantastic. I think I gave them 10 out of 10, and for me, I've covered the stock for around about 2 years on the YouTube channel, and I do think it's a fantastic company, and I do own the company. But even now, I do think it has plenty more upside. But let's look at what potentially that upside can be, and what potentially the negatives could be to stop it having that upside. Now, very quickly, I wanted to go on a little bit of a time travel. So I wanted to go on a little bit of time travel just to kind of, I don't want to focus too much on the bullish case today because I've covered it so much. But I just wanted to show you, it's something I've not done time traveling before on the YouTube videos, but I just wanted to show you how good it actually is. Obviously, we know last time we had the Q2 earnings, and obviously they were really good. EPS beat, revenue beat, up 83% year over year. Then they hiked up the guidance as well. So we did have a triple beat on their earnings, and this was actually well received. If I just actually go back on Seeking Alpha, you can see here Hims and Hers up 13% on Q2 2023 beats. So you can see here, relatively when these earnings came out on the 7th of August, the stock was actually rallying off those earnings. And then even since then, if we do go back to the 8th of August, since they brought out that triple beat and the stock was up, since then the stock has dropped even lower. It's crazy. The stock's nearly had a 20% swing since the triple beat of earnings, which is crazy. But just going back into the time machine, just to put it into context of how good Hims and Hers is, if we have a look at what analysts were expecting a year ago, so obviously this is what Hims and Hers are doing right now. Let's go back in time, let's go back a year, and by the power of Wayback Machine, we can go actually to what analysts were forecasting a year ago. So if we go back to what Yahoo Finance was saying a year ago for Hims and Hers, you can see the next year, 2023, which obviously is the current year now, if you go on the new page that's up to date. So if we go from a year ago, the average EPS was for them to lose -0 to 8. So what are they actually doing now? What's the current forecast for analysts? -0.14. So that's better. That EPS loss has gone down by a half. That is a rapid improvement from a year ago. That is super impressive. If we look at what the revenue growth was supposed to be, next year, 2023, they're expecting 24% year-over-year growth. Let's look at what analysts' latest forecasts are. So the current year is now 60%. So the losses are down by half, as forecast by analysts from a year ago, and the revenue is treble what it is. And I would expect that revenue growth to actually be more towards the 70% by the time this year is over. So that is some improvement from where you go from a year ago to where we are now. Absolutely insane. And the crazy thing is, you look from where they're going to be in a year's time, they're forecasting to drop down to 23% revenue growth. I think it's going to be much better than this. And if you look at the EPS as well, I think we're going to see this in a positive way as well. So it shows you that analysts have improved massively from where they were a year ago. Not that that's had any benefit in the share price. We're talking, this screenshot here is taken from the 7th of July 2022. I mean, if we look at where the stock was on the 7th of July 2022, the stock is, let's go from about there, it's only up 23%. So the EPS losses are down by half, the revenue is up by triple, and yet the stock is up 23%. And sometimes, unfortunately, guys, as a stock market, the share prices don't always make sense to what the fundamentals of the company is doing. But as long as the company keeps doing these fundamentals, eventually it will get rewarded on the share price. Anyway, that's enough of the positives. Let's talk about negatives. What is the negatives from this stock performing badly, I guess, in the next few years? Well, obviously the big thing that everyone talks to is, obviously, what are the two things to have a successful company? Revenue growth. Obviously the revenue growth has no signs of stopping if we go on the recent earnings. Losses. Obviously, when you are a company that is a loss-making company, you don't have earnings. People like to go off earnings. It's always a bit questionable what your value growth stocks are that lose money. Whereas if you've got a company that's profitable, everyone goes, oh, you know, it's earnings, you times that by a multiple, this is how much you're paying up for earnings. It's quite mostly well documented on what potentially a company can trade at if they're profitable. The unknown with an unprofitable company is what they're going to trade at when they are profitable, and what growth are they going to do, what profit they're going to do. And that's the really tricky thing. So the big thing would be that they are currently making losses. Now, your easy argument to that is that obviously, you know, the losses from where we were was 19 million in the last quarter. You're down to 7 million. So the losses are coming down by obviously over half, even more than that. So obviously, you know, the revenue growth is strong, but at the same time, you'd say, well, they are a loss-making company. But your argument is they very much are on a path now to profitability. As you look at more and more over the next few years, they are going to be, you know, generating profitability if they keep doing what they're doing. Another thing is, obviously, from an adjusted EBITDA point of view, adjusted EBITDA, they are profitable as well. They've gone from a 7.5 million loss last year to a 10 million gain this year. So the one big issue that I think most people do use is that it's a loss-making company, but as you can see, the losses are coming down rapidly, and they are now adjusted EBITDA profitable as well. So that's probably a very easy case to dismiss, really. The next thing is what I would say is probably the bigger risk with Hims & Hers, and that would be more to competition and regulation kind of aspects. Now, what Hims & Hers used to do is they actually used to break down their prescription to non-prescription revenue, subscribers to non-subscribers, and they also did revenue by product. So you can see here it's wholesale, you've got sexual health here making up 57%, and you've got hair, dermatology and other making up 35%. So obviously you can get a breakdown of the revenue, and obviously at the moment you can see the green part of the circle here makes up a very big chunk of their revenue, and obviously a lot of that is to do with their ED side of it. Now obviously the big thing is if something wants to change around there, or how they are to prescribe it online, or if they do it in person, obviously that would be the biggest risk to the company, is that element that makes up a lot of it, revenue. What happens if competition comes in? What happens if regulation comes in? That is without doubt the biggest risk to Hims & Hers. Now the thing is in the recent earnings, Hims & Hers don't actually break down their revenue anymore, probably because of that element. And obviously, you know, that you're not realizing, or you can't work out what exactly which category is growing at certain rates. You know, let's say, you know, mental health, for example, you know, since this time frame they have launched new products, which is worth saying, that are in this circle now. So I don't think it would be making up this much of what it is at the moment, but you know, these new products come in and then you can actually work out how much they're growing at. I think they do that for obviously a little bit of privacy, that they want to keep that information for themselves, but that's obviously something that you kind of got to consider, and they don't show it in the recent the investor relations because of that. You know, if you all of a sudden see a category and then in the next earnings, let's say that category is down 10%, you're like, oh, what's going on there? So I think obviously that's probably something to what would probably be the big thing, is either competition or regulatory point of view from certain categories. But you would say, like, obviously the big thing is that they're adding newer categories into this all the time. You know, that's been kind of the sexual health part of the business has been kind of the main part of the business for, you know, many years. So it's obviously going to be, it's the most mature part, so it's obviously going to be a bigger part of the circle. But the big thing is from Hims & Hers is they keep adding in new more and more kind of products into the company. So an example would be, you know, the mental health part of the business that's been coming into the business. You know, you got the new weight part of the business, which is getting added into the business soon. And obviously when you look at these markets that they're adding in, you know, they say 100 million in the population. When you actually look at these markets they're added in, like if you take weight loss, for example, weight loss is currently worth 305 billion by 2030, and it's growing at a 9.7% CAGR. And obviously, as you probably know, as societies, we are getting a little bit fatter. So there's still, that is probably the risk, but the point is that Hims are building up more and more categories, as you can see in this presentation, that if that was the risk, then you say, well, eventually these categories get to a point where maybe they make up 20% of the revenue, and sure, if something was to happen from a regulation or a competition point of view, you go, that's a bit of a nightmare. But there's a big difference between if it makes up 57% of your revenue, or as they add more and more categories in, you know, it goes down to, you know, 20% of the revenue. And that's what the big thing that is key for Hims to keep adding in more and more going forward. And you would say, like, obviously that's been investment into the company. As you can see here, operations and support has gone up, technology and development has gone up, G&A has gone up. But as an investor, you want to see them take more market share, expand, go into these new categories, become more of a diverse company. So you could argue, oh, it is going to drive the costs up a little bit, but in the longer term, that's what you probably want the company to do, and you don't mind if it's going to generate a lot more longer revenue and potentially even customer cross-sell as well. You know, that's going to be, you know, magical for the company, you know, further down the line if they're able to cross-sell. So we know, obviously, if you take the likes of operations support, if you know support, if that didn't go up, you know, 12 million, technology and development, obviously if that didn't go up 5 million, you know, you're on 17 million, you know, another 10, let's call it 10 there, you know, 27 million. No, Hims and Hers could have put profit in this year, but as me as an investor, I would rather them keep investing into the company, cross-sell these products more and more, and have more diverse of a revenue, and, you know, go for these, you know, 305 billion categories, you know, go for them, because the big categories, you know, even if you take, you know, 10% of the market share, if you only take 5% of the market share, the category size is huge, and it's definitely worth them going for. So I think those are probably your two big risks to stopping the business from performing, really. Is obviously it's loss making, but they are coming down a lot. And the other big risk, I would say, is the fact that if regulation or competition came in, but obviously as an investor, I look at that and go, they are dealing with that, they are adding in new categories, they are diversing revenue more and more. So if something was to happen to one category, they've still got plenty of other categories to support them, and that's the big thing that we want to see them keep improving more and more. So that's what I would say is the only negative to the business. So let's have a look at what potentially the company could do. Could they be a 5x kind of company here? So if we have a look at the moment, ticker symbol Hims, it's around a $6.81 stock as I recorded this video this morning, 1.4 billion market cap company. I don't expect them to do any share buybacks, even though it says yes there. I don't expect them to do any share buybacks for the next 5 years, even though they will probably be profit making, and they do have an awesome balance sheet, which I haven't even mentioned in the video. Let's look at revenue growth. Now, like I said, revenue growth is the tricky thing. How much are they going to grow at? Obviously, as they mature, they aren't going to grow at the rates they have been doing. You know, 68% forecast for this year. Even the current year is 60%. Obviously, we go from a year ago. You know, analysts were expecting Hims to start slowing down. They were expecting 24% growth this year. Obviously, they are going to go 60%. Next year, they are expecting to go 23%. Same again, I think they'll get it wrong. I think they will grow a little bit quicker. But that's the big thing that's one of the big things that's going to dictate where the stock goes. What rates are they going to grow at? Now, I put 25, 28 and 30%. Like I said, this is massively up for debate. I think that's a fair amount. That assumes some slowdown from where they are at right now, but I still think this is going to be a fast growing company. Let's look at profit margins. Now, I've gone 5, 8, 10%. Same again, this is where the big debate comes up, and this is why growth stocks have that little bit more risk, because it's not as guaranteed what the revenue growth will be. It's not guaranteed what the longer term profit margins will be. But as I take into the profit margins, what I'm taking into context here is that they do currently do, if I scroll up here, 82% gross margins, which is obviously very, very good gross margins, and that gives them a lot of room potentially to get to profitability. The other thing that I am taking into consideration, and this is because I have a lot of knowledge on this company, is I know the company is targeting EBITDA margins of 20% in the longer term. I think they can easily get a 10% profit margin out of that. Obviously, that is not including the likes of share stock-based compensation and everything like that. So I think 10% is a fair one to assume, but even then I've gone cautious at 8 and 5% profit margins. Obviously, what multiple do they trade at? That is the tricky thing. Obviously, if you are a company that is growing either at 25, 28% and 30% and you're a profitable company, you aren't going to trade at 20 times earnings. You aren't going to trade at 20 times multiple, let's be honest. Obviously, then it comes to a little bit of a risk element of what does it trade at. Now, obviously, I've gone 40 times earnings, which I think is relatively fair. I look at a lot of companies that trade at them sort of growth rates that are profitable. Whether the ones that come straight into my head is Mercado Libre, which obviously grows, I think, 30% at the moment. So that's very similar, and that trades even higher than 40 times earnings. Tesla obviously is growing around probably a little bit slower than what Hims is right now, and obviously is profitable as well. Obviously, that is something like 60, 70 times earnings. So say again, I think that was quite conservative. So, I mean, ultimately it depends on the profit margin more than anything, but on the low side, you know, if we do grow at 25% and we do a 5% profit margin, I think we could see an easy double up here. You know, if we're looking at a 8% profit margins at 28% growth, you know, you're talking 365%. If you get a 30% revenue growth, 10% profit margins, that's where I would want them to see longer term. Obviously, you're looking at, you know, 40 times earnings, you know, 571% upside. So that is where you're going to get your 5x stock. If the company is able to maintain 30% revenue growth and get to a 10% profit margin and it trades at a premium, which I think if you're doing them numbers, you will trade at a premium. And then you can see that the upside is there. So yeah, I think you could 5x, but obviously you can see the numbers they have to do over the next 5 years to get there. Now, let's just I want to be a little bit silly. This is where sometimes you can hit the big numbers. Let's say they outperform even what I'm expecting from them. Let's say they are able to potentially, let's say they are able to hold on to a higher growth rate. Let's say they grow at 35%. 10% profit margins, I think in the next 5 years, I think in the next 10 years, they can get above a 10% profit margin. But in 5 years, I can't see them ramping up more than 10% profit margin, so I aren't going to change that. But let's say they still hold on to a lot more growth. Obviously, 35% growth, 10% profit margins. Let's say that the market, we're in a bit of a bull market. The market really loves it. Let's say it's not 40 times earnings. Let's put it a little bit higher. Let's say the market goes, you know what, let's put this at 60 times earnings. Obviously, I know you don't naturally assume that it's going to be at premium, but let's just be, you know, on the high side. What potentially does the market think it could be valued at? And you can see here that comes a 10 bagger. So if we do have 35% revenue growth with 10% profit margin and we do go to a higher valuation or higher multiple expansion of 60, it does look very good on the upside. But obviously that is very, very bull case scenario. But I mean, even if we look fairly conservative, if they do keep up decent growth and do get to profitability, I could easily see this doing very well. But to achieve that kind of 5x return, obviously I think it is doable, but obviously a lot can change in 5 years. But obviously you can see the numbers now, what they would potentially have to do to kind of get there really. So yeah, overall, Hims and Hers, can it come a 5 bagger? It can. Obviously it has to hit good numbers and obviously keep adding to new income streams and manage competition and make sure, obviously there's no regulation next 5 years, but it can do it, and we'll see what happens. Obviously we'll be following it here. I think I've been following this stock for around about 2 years now, so obviously it would be about half the way as these numbers are forecasting now if we went for the same time period. So yeah, obviously it's one that I do plan to own for the long term, and it is one of the stocks I own that I do own and hope it does come in with the higher side, and this will be one of the stocks hopefully that helps me, you know, beat the S&P 500 in the next 5 years. But we'll see what happens as always. But I thought I'd talk about this one because there's been a lot of questions about it, and obviously I'm still pretty bullish on it, and I think the company's still doing a good job. Hope you enjoyed the video. Catch you in a bit.